While some volatility was seen in the markets last week, the overall trend didn't change. Euro strength and yen weakness continued to dominate. Indeed, it should be noted that some important technical levels were decisively taken out, including 1.35 in euro dollar, 120 in euro yen, a medium-term trend line resistance in euro sterling, and 1.30 in euro Aussie. All these developments indicated a strong underlying momentum in the euro, and the strength was rather broad-based. That's also a clear indication of funds flowing back to the eurozone from everywhere as sentiments stabilized. Meanwhile, despite some hesitations, yen crosses were bid up again towards the end of the week. And both dollar yen and euro yen took out a near-term channel which indicated accelerations. Overall, we anticipate the trend to continue. Elsewhere, in spite of a rebound attempt, sterling ended up as the second weakest currency last week as economic data showed that recovery in the UK would stall. The Aussie remained weak and was weighed down by Reserve Bank of Australia's expectations as well as mixed data from China. The Canadian dollar staged a strong rebound last week, but the price structure still suggested that it's merely a correction. The Swiss franc continued to track the euro closely as euro Swissy is bounded in range. Mixed data from the US didn't give the dollar a clear direction as it just followed others. Looking forward, we expect to see euro buying and yen selling to continue. Sterling should still be avoided as it will probably be overwhelmed by the euro. Aussie shorts could be maintained but better against the euro rather than dollar. The dollar will continue to have no clear direction in general, so we prefer to continue euro-yen long ahead. The Fed maintained the pace of asset purchases at $85 billion and left the policy rate unchanged near 0%. There were few changes in the policy statement. Yet policymakers noted that growth in economic activity paused in recent months, suggesting the monetary stance should remain accommodative. The central bank should remain in a wait-and-see mode so as to monitor the impacts of fiscal austerity, in particular expiration of the payroll tax holiday expiration. Economic data from the US was mixed. Q4 GDP showed an unexpected contraction of 0.1% versus consensus of 1.2% growth. The GDP price index also rose much less than expected by 0.6%. Conference Board consumer confidence dropped more than expected to 58.6 in January, compared to expectation of 64. That was the worst reading since November 2011, and the 8.1-point drop from December's revised reading of 66.7 was the largest deterioration since August 2011. However, ISM Manufacturing Index beat expectation and jumped to 53.1 in December. The non-farm payroll showed the U.S. job market grew by 157,000 in January, similar to expectation of 155,000. And last month's figure was revised sharply up from 155 to 196,000. However, the unemployment rate unexpectedly edged higher from 7.8% to 7.9%. Headline durable orders rose strongly by 4.6% in December versus expectation of 1.9%. Ex-transport orders also rose more than expected by 1.3% versus consensus of 0.8%. The euro strength is a clear indication of a continuous improvement in the confidence towards the eurozone. Another clear indication was that Italy sold its maximum target of €6.5 billion in 5 and 10-year bonds with steeply lower yields. The smoothness of the auction showed markets are calm regarding the situation in Italy, even though there are just over 3 weeks before an important parliamentary election. Sterling, on the other hand, was weighed down by weak data. UK PMI manufacturing misestimated. Overall bearish developments in the pound were driven by weak economic data, funds flowing back to the Eurozone, and the next Bank of England's Governor Mark Carney's comments. The Treasury Committee of the House of Commons will ask Carney to have a hearing on February 7 on the current policy framework. Sterling's direction, if not down, will be more dependent on this event. The Japanese government raised the 2013 to 2014 growth forecast to 2.5% compared to August's projection of 1.7%, as the country emerges from recession. CPI growth is expected to be at 0.5%. Finance Minister Aso predicted that there will be 43.1 trillion yen in tax revenue in 2013 to 2014. Total spending is expected to be at 92.6 trillion, while there would be 42.85 trillion raised from bond issues. That would be the first time in 4 years that tax income would exceed new debts. Aso said that for 3 years the bond issuance exceeding tax revenue is abnormal, and it's a big deal. It's turned around. However, some economists are skeptical on whether tax revenue could fall short of the estimate. The Kiwi was supported after trade balance unexpectedly showed a 486 million New Zealand dollar surplus in December compared to expectation of a 105 million deficit. That was indeed the largest surplus figure since 1991. The Reserve Bank of New Zealand announced to retain the official cash rate at 2.5%. The meeting statement was more upbeat, noting that global growth is set to recover in 2000.